Welcome to the Accounting Desk. Today, we explore the heart of public sector transparency by diving into IPSAS 20, Related Party Disclosures. Have you ever wondered how public trust is maintained when government finances are reported? Imagine a framework that holds entities accountable while balancing necessary confidentiality and open disclosure. This is IPSAS 20, a standard designed to ensure that relationships and transactions which might influence decision-making or financial statements are clearly reported. Over the next 10 minutes, you will gain an insightful understanding of why IPSAS 20 is crucial and how it transforms public sector financial reporting. Let us begin by exploring the purpose and scope of IPSAS 20. At its very core, IPSAS 20 exists to ensure transparency in financial reporting. Public sector entities operate in environments where accountability is paramount. You, as an accounting professional or student, know that financial statements must convey not just numbers, but the stories behind possible influences on those numbers. IPSAS 20 guarantees that the financial statements include all relationships and transactions that might affect the fairness and objectivity of the reported information. Financial statements are not mere figures on a page. They are windows into governance, integrity, and accountability. As you encounter these statements, ask yourself, who are the players behind the numbers? Who might have influence over decisions based on these transactions? Recognizing and disclosing these relationships fortify public trust and ensure that every stakeholder gets a full picture of the financial landscape. The application of IPSAS 20 is broad, but also carefully defined. It applies to a majority of public sector entities that prepare their accounts on an accrual basis according to IPSAS financials. There is a critical exception. It does not extend to government business enterprises and consolidated financial statements at the group level, which have other tailored standards. This clear delineation helps maintain consistency across various entities, ensuring that all, particularly those directly impacting public finance, adhere to the same rigorous reporting requirements. Have you ever encountered a report that made you question whether all pertinent information was disclosed? IPSAS 20 addresses this potential conflict head-on by demanding precision and accountability in reporting related party relationships. Let's now turn our focus to a key element. What exactly constitutes a related party? A related party is not just anyone. IPSAS 20 sets a clear framework for identifying related parties. First, these include controlling entities that have direct influence over others. They also cover entities that are under common control with the reporting entity. Next, crucial players are key management personnel, often the ministers, directors, or senior officers steering the course of public policy and financial decisions. Their influence is significant, and their transactions raise the stakes for transparency. But the definition does not end with individuals. It extends to those closely related to them, immediate family members, whose connections might indirectly affect the objectivity of decisions. Additionally, if these key personnel have control over or associated interests in other entities, those relationships come under scrutiny as well. It is a comprehensive approach designed to catch even the subtlest connections that might impact financial integrity. Picture a flowchart that begins with the reporting entity at the center. Branches extend outward to include controlling entities, key management personnel, and their family members, each linked to other entities with potential influence. This visual is not just an abstract idea. It is a practical tool that reinforces the objective behind IPSAS 20. It reminds us that every link in this chain needs to be transparent to uphold public trust. Once you understand who qualifies as a related party, the next step is to examine the types of transactions that require disclosure. Transparency is not about overwhelming details. It is about revealing critical information that might influence decision-making. IPSAS 20 mandates that all significant transactions between related parties be disclosed, even if they are conducted under normal market conditions. Consider this: any purchase, sale, or transfer of goods or services between related parties must be reported. But that is not all. IPSAS 20 encompasses transfers of resources, liabilities, guarantees, lease arrangements, loan agreements, and even the provision of management services. Each of these transactions, if significant, holds the potential to impact the financial fabric of public sector reporting. Whether you are reviewing a purchase agreement or a complex lease, the standard ensures that you know the nature and the terms of these transactions. This might sound extensive, and indeed it is. However, this comprehensive requirement is what secures the bedrock of transparency, ensuring that all facets of related party interactions are brought into the public light. There is a balance. While transactions must be disclosed to prevent any hidden influences, IPSAS 20 also takes care to respect the necessary confidentiality. This dual aim is at the heart of the standard. Next, let's delve into the detailed disclosure requirements mandated by IPSAS 20. It is essential that every entity clearly communicates several key pieces of information in their financial statements. First and foremost is the nature of the relationships. You must understand the connection between the reporting entity and its related parties. Is it a direct controlling relationship, or perhaps an indirect influence through familial ties? Clarity here is the linchpin of transparency. Additionally, the types of transactions involved must be noted explicitly. Are we discussing purchases, sales, or complex financial arrangements such as guarantees or loans? Knowing the specifics helps stakeholders assess whether these transactions were conducted on an arm's-length basis, or if they might carry hidden advantages or disadvantages. The value of each transaction is another critical disclosure. It offers tangible data that stakeholders can evaluate to understand the potential impact on financial statements. Terms and conditions also come under scrutiny. When dealings are not at typical market rates, further explanation is required, effectively turning the spotlight on any preferential terms that might suggest undue influence. A special area of focus is the reporting of key management personnel compensation. IPSAS 20 requires entities to consolidate all such compensations, reporting them as overall categories rather than individually naming figures. This ensures that while details remain protected, the necessary aggregate information is accessible for review. These categories include short-term benefits, post-employment benefits, termination benefits, and other long-term benefits. This section of IPSAS 20 resolves a significant conflict: the balance between maintaining confidentiality and achieving transparency. On one hand, safeguarding individual identities is crucial. On the other, stakeholders deserve enough information to understand the financial implications of these relationships. IPSAS 20 smartly navigates this divide by allowing the confidentiality of individual names unless legal requirements dictate otherwise, while still ensuring that critical details about transactions and relationships are fully disclosed. Imagine a disclosure note that reads, "During the year, the entity entered into transactions totaling $1.2 million with a company owned by the spouse of a senior official. All transactions were conducted at prevailing market rates." Such clarity not only informs, but also reassures stakeholders that every significant detail has been examined and reported. It is also crucial to understand scenarios that do not require disclosure. IPSAS 20 is specific about when information should be reported. Transactions involving normal dealings with the public, such as routine payments for public services or taxes, are excluded. Similarly, if a related party exists but no transaction has occurred, there is no necessity to disclose it. This precision avoids overloading financial statements while still delivering full transparency where it matters most. Throughout this discussion, a recurring theme is evident: the pursuit of transparency and accountability. Each element of IPSAS 20, from identifying related parties to the intricate details of disclosure, is designed to build and maintain public trust in the reporting process. When you, as a financial professional, understand and implement these principles, you contribute to a system where decisions are made on the basis of complete, accurate, and impartial information. As we near the conclusion of this session, let us reflect on everything we have covered today. IPSAS 20 is not merely a standard. It is a commitment to ensuring that every financial statement tells a complete story. It underscores the importance of disclosing relationships that could influence decisions and stresses the need for detailed reporting of significant transactions between related parties. Moreover, the careful balance between discretion and transparency highlights the sophistication of IPSAS 20. The standard ensures that while the identities and personal details of individuals remain protected, the financial impact of their relationships is not hidden from public view. This dual focus is what sets IPSAS 20 apart as a pillar of accountability in public sector financial reporting. Transparency is not an option, it is a mandate. With IPSAS 20, regulators and financial managers alike have a robust framework that reinforces a culture of openness. When you implement these requirements, you transform not only documents but also the integrity of public sector operations. Every disclosed transaction, noted relationship, and clearly communicated term contributes to building a trustworthy financial narrative. In summary, we have explored the purpose and scope of IPSAS 20, the nuanced definition of related parties, the wide array of transactions that fall under its umbrella, and the specific, detailed disclosure requirements that are fundamental to its application. We have discussed how disclosure notes should be crafted to provide clarity while still maintaining necessary confidentiality. This standard ensures that whether you are reviewing budgets, auditing statements, or simply studying financial reports as part of your education, you grasp the full picture behind every figure. As you conclude this session, remember that the integrity of public sector financial reporting rests on transparency and accountability. IPSAS 20 provides the necessary tools to achieve this, ensuring that all relationships and transactions with potential conflicts of interest are made visible and are evaluated rigorously. Get ready to use these insights to enhance your work or studies in accounting. Thank you for taking the time to explore IPSAS 20 with us. If you found this session valuable, like, share with classmates, and subscribe for more IPSAS content. Your support helps us continue to provide clear and impactful explanations that bring transparency to public sector reporting. Stay curious, stay informed, and contribute to making public finance truly transparent.